Yeah, morning traders. What a message the market's been sending us over the last 12 hours or so. Yeah, it's been powerful, it's been intense. The repricing in rates has been spectacular, to say the least. But I think the market is clearly saying that the efforts from the FDIC, the US Treasury Department, and the Fed are potentially not going to stave off a full contagion effect. There's going to be clear pain that's going to resonate still through the financial space. And I guess the other message there is that there's going to be higher regulation. There has to be higher regulation, and that's going to have severe implications for the demand for credit and the lending standards going forward. And that's going to lead to potentially slower growth playing through in various regions as well. But certainly the earnings of the banks very much in play of that potential tighter regulation that's going to have to come. We've seen that in the European banks in terms of the stocks 50 financial sector down 6.7%. Credit Suisse was down nearly 10%. Everyone's focused on credit default swaps at the moment, certainly in Europe, and we saw the European credit default swap financial sector up 111 basis points there. So, certainly the cost to insure against debt default obviously blowing up there. In the US, banks have obviously been the poster child of everything that's been going on. Certainly some of the regional banks have been absolutely carted out. You've seen the KBW banking index down 12%, having its worst day since 2020. Similar sort of moves in the KRE, the regional bank ETF there as well. Have a look at that rates repricing we've been seeing there, because the market is now saying that we get about 13, 14 basis points being priced for next week's FOMC meeting. Goldman Sachs, a number of banks coming to a pause sort of stance. In fact, Nomura, sort of the banks caused a bit of a stir, suggesting they actually now see a 25 basis point cut next week and a pause on quantitative tightening. It's the front end of the curve which has really collapsed. We've got 2-year treasuries down 57 basis points at the moment, trading just above 4%. The back end of the curve seeing good buying, but nowhere near to that same extent. And that's a similar sort of situation we saw in Germany, where German Bund 2 years have absolutely cratered as well. Now the dollar's been flogged on the back of that, down about 90 basis points, following what we've been seeing in rate differentials, certainly high beta effects, benefiting nicely from that. We've seen good buying in gold and crypto, really benefiting from this situation. Actually, equities held up pretty well at an index level, very defensive buying playing through in tech as well, long duration assets working quite well. But it's the banks, once again, very much in focus. We'll see how Asia trades this one.